Talk in more detail about that jobs report and the impact for markets across the world. Marc Faber joins in for that. Marc, good morning. Thanks very much for joining in. What did you make of the jobs report and the takeaways from there, which is that the taper program may begin sooner than most expected?
I don't know, because the Fed doesn't know either when they will slow down their bond purchases. First of all, on a closer analysis, the jobs report wasn't particularly good, because a lot of full-time jobs were lost and part-time jobs were added. So I wouldn't call now the jobs report as a supportive of, say, tighter monetary policies. I have to say that the Fed basically believes in money printing, and they will continue to print money, in my view. The question is, at what pace they will continue to print money.
What did you make of the very sharp spike in the US bond yield, Mark, on Friday to about 2.74? That's got emerging markets worried this morning. Would you expect to see further rise in the US bond yield from here?
Well, basically, it's interesting that since then they initiated QE Unlimited a year ago, bond yields have been rising regardless, and it will be interesting to see in the months ahead what the impact of the increase in interest rates is on, say, the housing market and on asset prices and so forth. So I would say, looking actually at the past predictions by the Federal Reserve, they have no clue themselves. I think the view at the Fed is it will cause less damage not to taper off than to taper off. That would be my assessment of their thinking. Not that I would agree with it, but that is the way they think.
This news flow has spelled bad news for the Indian currency in specific, Mark. We've gone all the way below the 60 level. There is a bit of a panic situation on where it could be headed. Do you think all these macro issues, the currency, the deficit needs to be addressed urgently?
Yes, they better deal soon with it. Otherwise, the currency will continue to weaken. And let me just remind you, the Indian market is still lower than it was in January 2008, and in US dollars, the Sensex is down precisely 41%, because in January 2008, $1 was still worth 39 rupee, and now it's worth 60. So again, when you talk about stock markets, yeah, maybe the stock market doesn't go down, but the currency goes down, or the stock market goes up and the currency goes down even more. And when the currency weakens, it hurts the average household much more than the few well-to-do people.
That's the currency, Mark, but what about emerging market equities? Do you see more pain ahead for all these markets, even more than what we've experienced over the last few months?
In general, I think that most stock markets peaked out, some already in 2011, some didn't even make a new high above the 2007 highs, and I believe that there is further downside risk in all markets, including the US.
There's also been a big surge on crude prices, Mark, 5% up last week. Is this just a geopolitical one-off that's happening with crude, or do you think something fundamental is changing with that commodity?
Yes, actually, I think personally, I believe that crude is one of the very few commodities that actually look attractive from a longer-term perspective. Between last November and February of this year, I was 5 times in the Middle East on 5 different journeys. My impression is that the whole Middle Eastern problems will get much worse before they get better. And maybe it will take years and years until they improve. But again, as I mentioned to you, for you, you think money printing is the greatest things on earth. Money printing has a very destructive impact on economic life, on social conditions also, because when you print money, some assets go up in price and some goods and services also go up in price, and usually the increase in these prices exceed the typical wage, the typical salary. And so most people actually suffer under money printing, but money printing benefits a few. And so wealth and income inequality increases, and it leads to social tensions and also to geopolitical tensions.
Thanks, Marc, very much for joining in today with your assessment. That's Marc Faber saying that he sees more pain for emerging markets in the months to come.